Hello and welcome to Finance RM. This will be the lesson on how do banks function and what do they actually do. So, what is a bank? A bank is a licensed financial institution that offers a range of services, including deposit taking, lending, investment, money transfers, currency exchange, and wealth management. The core purpose of a bank is to safely store money, facilitate financial transactions, and allocate capital efficiently in the economy. Modern banks function as intermediaries between depositors and borrowers, playing a key role in the financial ecosystem by accepting deposits from individuals, businesses, and institutions, lending money to those who need it for mortgages, business, and cars, etc., and earning a profit from the difference between what they pay on deposits and what they earn from loans, called the interest rate spread. How do they work in a step by step process? The deposits. Customers deposit money in their bank accounts. These deposits are liabilities for the bank because they owe you money, and the deposits from the bank's primary source of funds. Reserves and liquidity, as banks are required to keep a portion of deposits in the reserves. The reserve ratio is often set by the central bank, example 10% in some countries. These reserves ensure that banks can meet daily withdrawals. Lending. The remaining money, usually 90%, is lent out to individuals or businesses. Banks charge interest on loans, which is a primary source of income. Interest income. Interest from loans, example, let's say 7%, is an income. Interest paid to savings accounts, let's say 1%, is an expense. The difference is the net interest margin, or NIM. Investments, which have banks also invest in low-risk securities like government bonds, corporate debt, or treasury bills to generate income. And fee-based services, such as ATM fees, overdraft charges, wire transfers, currency exchange, insurance, and credit card fees, all generate non-interest income. So, the types of banks include the retail banks, which serve individuals and small businesses, commercial banks, which serve medium to large businesses, investment banks, which help corporations raise capital, advise on mergers and acquisitions, regulate money supply, issue currency, and manage national interest rates from central banks, credit unions, which have member-owned banks, often community-based, and online or neobanks, which operate digitally with minimal or no physical branches. Now, we will talk about the types of banks' accounts, as they offer different types, each with specific purposes, features, and benefits. Here's a detailed comparison. A current checking account. The purpose is that it's designed for everyday transactions and payment activities, and it has no or minimal interest, a debit card and a checkbook, a direct deposit for salary, online and mobile banking, and unlimited transaction. But the drawback is that it doesn't grow your money. It's useful for spending, but not saving. It's best for salary holders, students, daily use, and bill pay. Next, the savings account. The purpose is designed to store money and earn interest over time. Its features include interest paid monthly or quarterly, withdrawal limits in some countries, and encourages financial discipline, and the types include regular savings, high yield savings, which is higher rates but more restrictions, and youth savings for minors. It's best for emergency funds, short-term goals. Next is the fixed deposit accounts, or the FT term deposit accounts. The purpose is to lock away a lump sum for a fixed period and earn a guaranteed return. And its features include a fixed tenure from 1 month to 10 years, a higher return than the savings account. Premature withdrawals incurs penalties, and interest can be monthly, quarterly, or at maturity. It's best for long-term savings, capital preservation. Next, the money market account, or the MMA. The purpose combines savings accounts interest rates with limited transaction features. It includes higher minimum balance requirement and moderate interest rates, and it often allows writing checks or debit card use. It's best for individuals with large balances who want better returns with liquidity. Business bank account. The purpose is to manage business transactions, payroll, vendor payments. It features higher transaction limits, multiple signatories, accounting software integrations, business loans, and lines of credit. It's best for entrepreneurs, freelancers, and SMEs. Private banking and wealth management accounts. Its purpose is that it's a premium services for high net worth individual. It features personal banker or relationship manager, investment portfolios, access to exclusive funds, lower loan rates and higher deposit rates, and it's best for investors, wealthy clients, corporate executives. Now, interest. What is interest? Interest is the cost of borrowing money when you take a loan, or the reward for saving money when you deposit it. The types of interest. Simple interest. It's calculated only on the principal. Let's say you deposit $10,000 at a 5% simple interest for 2 years. So that 10,000 times the 0.05 for 2 years is 1,000. And in the end, you'll have 11,000. Compound interest is calculated on the principal plus accumulated interest over time. It's where the compounding of, let's say you invested $1,000 in 1 year at a 10% rate, you would have 1,100. But next year, instead of getting 100 from your base, it's compounding, and instead you get 110. How they work for loans. When a bank lends money, credit card, personal loan, or mortgage, it charges interest. The rate depends on the central bank base rate, your credit score, loan type and tenure, and risk associated with the borrower. The types of loan interest have a fixed rate, which is unchanging, and a variable rate, which changes with central bank rate. How interest rates are determined. Inflation control. High inflation, high rates to cool economy. Economic growth. Central banks may lower rates to stimulate borrowing. Demand and supply of credit. Monetary policy tools. When do you earn versus pay interest? If you borrow money, it's a loan. You pay to the bank. If you save money, because it's a deposit, the bank pays you. If you invest in fixed deposits, since it's a fixed deposit, the bank will pay you. And if you use a credit card late, that's an unpaid balance, so you pay high interest. An example is that you deposit $10,000 in a saving account at 1%, and the bank pays you $100 a year. The bank loans that $10,000 to someone else for a personal loan, and they earn $1,000 a year. That way, the bank's net interest is $900. So both you and the bank are making profit. Additional banking concepts. What is fractional reserve in banking? As its banks are only required to keep a fraction, let's say 10% of customer deposits as reserves. The rest is lent out, allowing for money circulation and creation. This expands credits and supports economic growth, but it also increases risk if too many people withdraw at once, which would result in a bank run. Digital banking and neobanks. The feature, a physical bank will be there in a traditional bank, but not in a neobank. The fees in a traditional bank is always higher than a neobank. The interest in a traditional bank is often lower than a neobank, and the speed of a traditional bank is slower than a neobank, which is almost instant. And the account access for a traditional bank is at the branch or online, whilst on neobank it's only online. Deposit insurance is to protect your savings, as most banks participate in national insurance schemes which are available throughout the world and different for different countries. A summary. Banks are central hubs of economic activity, and if you understand how banks work, then you gain control over your financial future. Banks can store your wealth and give you loans with both having interest. And the current account has no interest, high access, low risk, and it's best for spending. A savings account has a low interest, medium access, low risk, and it's best for saving. A fixed deposit account has a high interest, low access, very low risk, and a long-term saving. A money market account has a medium interest, medium access, low risk, and it's best for high balance. A business account has a variable interest, high access, low risk, it's best for entrepreneurs. And a private wealth account is a medium to high interest, a high access, low risk, and it's best for high net worth individuals. Remember, store your wealth safely, facilitate every payment and loan, fuel growth in homes, businesses, and government, and profit by managing risk and interest. Thank you for listening to me, and don't forget to drop a like on the video and subscribe to the channel. Do drop anything in the comments that you feel might be required, or if you have any questions. Thank you. And remember to be smart, stay smart, and achieve your financial goals.